Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we help you understand all the live closing action of the stock markets. We'll give you a wrap-up of the day's trade as well. First up, let's look at how the markets are trading at this point in time because the downside is actually getting extended. Look at the Sensex levels right here. We are closing in on to that 61,000 mark and 622 points down. We're trading at on the Sensex today. Look at the Nifty as well, 18,208. That's the level at which the Nifty is trading at. 175 points gone there for that one too. Over 1% downtick for both the benchmark indices as we speak. So the declining trend has extended towards the second half. And just like how I was pointing out in the afternoon trade as well, that this is the time, 2:33 p.m. You look at the move and the move either gets lifted or it gets further downside, and that's what you're looking at. The benchmarks trading near the lowest point of the day as well. What's really causing the declines? The broader market space that's seeing a sharper cut. Small cap index, look at that one. Nifty SmallCap 100 down by over 2% at the lowest point of the day too. MidCap 100 index down by 1.5% as well. And India VIX, that's the index you should not lose sight of. About 14% up right now, 15.7 is the level at which the India VIX is really trading at, clearly indicating at very, very volatile moves right here. The advanced decline ratio clearly skewed towards the declines. 37 stocks on the downside as far as the Nifty 50 stocks are concerned, as opposed to 13 stocks that are still seeing in the green. In terms of the various sectors of the Nifty index, the sharper fall really coming in from the metals pack, from the PSU banks, from the Nifty Bank overall, and the royalty space. These are the indices that are seeing very, very sharp cuts right here, led by losses in the PSU banking space. The downside here is 2.6%. It is trading with sharp losses right here. Profit booking really taking shape. The metals also down by 2.3%. Media stocks falling 3%. 1.3% down for the auto space as well. Financial services down by 1.6%. PSU banks, private banks down by 2%. Realty space down by 1.5%. So barring the two indices, it's the pharma stocks that are shining the brightest today, showing some very healthy gains, 2.5% uptick in an overall weaker market. It's the pharma stocks that are holding up very strongly. IT stocks providing support, 0.5% odd on the upside. The top gainers include a whole host of names from the pharma pack: Divis Laboratories, Cipla, Sun Pharma, Dr. Reddy's, Apollo Hospitals, all 5 from the pharma and healthcare pack. Downside, you do have some names from the FMCG basket: Britannia, ITC down in trade today, Adani Enterprises, HDFC, ONGC, the other laggards at this point in time. Let's welcome our guest for the day to really understand what does he make of the kind of move that we are seeing on the markets going forward from here. What should be your investment strategy too? Sunil Damania joins in. He is the Chief Investment Officer at MarketsMojo. Welcome, sir, and thank you so much for taking the time out onto this discussion. Well, what do you make of this kind of a declining move that we've been seeing from last couple of trading sessions? We did see the record high mark being touched on both the benchmarks 3 weeks ago, but the momentum hasn't sustained on the upside. There was a talk about 19,000 fast approaching on the Nifty. That hasn't happened. But in your view, how do you really look at the markets currently?
Thanks a lot, Sakshi, for having me on the show. I think, yes, you are right that there were expectation that market should go up, should have gone up. But
I think, are you on mute or something? Can you please check that? Yeah, please go ahead.
Yeah, I think you are right that we were expecting market to go to 19,500 kind of a level, but then market has its own way of, settling the score. If you look at it, I think there are a lot of headwinds that everyone is talking about. To begin with, I think what is happening in China is a cause of concern. We don't know how many people will get infected outside China, and there has been some advisory issued by the health ministry from India. And there is a concern that 10% of the world population could get impacted because of the new variant that has come on the surface. Number one. Number two, I think there is still little clarity about what's going to happen to the US economy, because Fed 4 times in a row hiked the rate of interest by 75 bips point, and the last one was 50 bips rate hike. One of the highest rate hike in the history of Fed since 1950 in any calendar year, 425 bips point rate hike in a year, which has not happened. And is it going to have a soft landing, hard landing in the US market? I think those are all the questions that the markets and investors are trying to grapple with. And we don't want as a clarity of thoughts what's going to happen. And that's really spooking the sentiments on the market. In fact, what has come as a big surprise that despite this kind of a volatility, Indian market seems to be holding it extremely well. If you look at in 2022, while the most of the global indices are in the red, Indian market seems to be going to close in the green. And I think that's the one big solace that we can take. So yes, market is volatile, but that's the nature of the market. But when the moment you basically zoom out and go beyond 3 months, 4 months, 5 months, I think it does give a sense that market seems to be poised for a very big rally in the months to come.
So where could that rally really take us to? Any kind of targets that you have in mind for the Nifty? Is it going to be 20, 21,000? We've been hearing, brokerage houses really pegging the Nifty at 50,000 in the next 10 years too. So I want to know from you, where are you pegging the Nifty at?
So I think normally what happens, normally the market would mimic what can be the nominal GDP growth rate in the country. And if you look at the India would have a nominal GDP growth of near about 13% or so in next 12 months or so. And that could be the kind of a gain in the Nifty that we can expect. So my sense is that if you have to discuss maybe same time next year, we should expect Nifty somewhere in the region of 21,000 or so. That's what my sense is. And of course, these returns are not going to be linear. We would see a lot of volatility coming in, very similar to what we experienced in 2022, when the first half was completely washed out for Indian equity market. And whatever the gain that we saw, it was in the second half. Something similar kind of behavior we could expect in 2023.
All right. Mr. Damania, the two pockets that have largely underperformed in this whole of 2022, the one is the IT space and the other is pharma. Your thoughts on these two spaces. Is it time now to start nibbling at least into the IT sector after the sharp fall and underperformance that we've seen? On the contrary, pharma is up today. Perhaps you mentioned, the trigger could be the rising COVID cases yet again that has been providing some kind of a fillip to the sector when the pandemic was raging on as well. But this whole of year, pharma space has really not performed to that extent. Your thoughts and the way investors should look at these two spaces going forward into the new year?
Sure. So, Sakshi, we were correctly predicted in 2021, that's the beginning of end of 2021, that IT would be underperformer in 2022. We have changed our opinion on IT sector post September 2022 numbers on IT sector. And we do believe that IT as a sector should do extremely well going forward. So our sense is that yes, till 2021, Indian IT sector did extremely well. And I think now the law of average should come back and say that 2023 Indian IT sector should do extremely well. Couple of reasons. One is that definitely attrition rate that was going beyond control have started coming down. And that would give a lot of headrooms for the IT companies to manage their supply side issues. Second thing, I think even if you listen to the commentary given by TCS or Infosys or HCL Tech, I think they're able to renegotiate some of the deal with their clients at much higher rate, in the sense that they're able to pass on whatever the employee cost they had to incur, or maybe the opening of the office or travel expenses, they're able to pass on to some extent some of their the additional cost. And that would we will see some stabilization in the margin coming in. Plus rupee benefit, that the rupee has depreciated by 8 to 9% in 2022. Some of these IT companies did hedge their position. Now that hedge will get unwinded in 2023, and the benefit of that will start accruing to that. So we strongly believe IT should be the sector to watch out in 2023. Yeah. Pharma has really underperformed since 2015. If you look at the NSE Nifty Pharma Index, it has struggled to report any meaningful gain despite the overall market moved substantially up post that. And I think there is a revert to the mean kind of a scenario where pharma should do extremely well. So it has underperformed very significantly in last 7 years or so. Now, and if you look at some of the pharma companies have done extremely good job in terms of, relooking at their industry that they are trying to, the geographic region that they are trying to address to. Generic prices which were coming under pressure have started now stabilizing, and that could give some fillip to them. And the complete product pipeline that some of the Indian pharma companies have, which they are going to launch in 2023, should definitely help them to get re-rated. So in terms of valuations also, they are commanding a very reasonable valuation. So it makes a lot of sense to look at IT and pharma. Yes, it's a contraband, but it does make a lot of sense to go into contraband.
Okay. What would be your portfolio strategy as we step into the new year? Would you be cautious at these current levels? Would you continue to deploy funds? And where exactly are you going to be deploying funds to?
So one, definitely, I 100% remain invested in the equity market. So that's my strategy. My complete, whatever the little assets I have,
Hmm.
100% invested in the equity market. But I do get a sense that mid and small caps should do extremely well in
Hmm.
2023. 2022 was not the year for mid and small cap. They clearly underperformed very
Yeah.
significantly. And if you look at historically, the total share of mid and small cap to the overall market cap, I think they've come down drastically low. And I think somewhere that needs to get corrected. So yes, I personally believe it's a time has come that investors have to, in fact, I myself is doing increasing allocation to mid and small cap. So my sense is that if you are a little aggressive investor, you should have almost 40 to 50% of your allocation to the mid and small cap, and balance 50% can be in a large cap. But here you need to be a little stock specific.
Yeah.
My sense is that market going to remain volatile in 2022, even though it's going to give positive returns, Nifty at 21,000, but it would be non-linear. And if you are not in the right company, you could end up losing a big time money within the mid and small cap and even within the large cap too.
Okay. What, according to you, will be the dominant theme in 2023? Will it be value stocks? Will it be growth? Will it be growth at a reasonable price? And what will be that theme exactly for 2023?
So if you look at it, normally the growth used to outperform the value for many years in a row. And in fact, many people, pundits actually announce that the value story is over. Surprisingly, if you look at MSCI value index in 2022, it has outperformed growth. And one of the reason is that growth normally does well when the rate of interest are benign, and that's what we saw in last 10 years or so. And in 2022, we saw a heavy, huge amount of rate hike from all central banks across the world.
Hmm.
And
Hmm.
due to that growth, company came under severe pressure. Whether it
Hmm.
was some of the best company have come under severe pressure. Now, my sense is that rate of interest that we have been seeing going up in 2022, I think the second half of 2023, they will start reducing. In fact, central banks will start reducing because my sense is that inflation will come under come under control by second half of 2020. And if that has to happen, I think again the growth story will come in war. So what's going to
Hmm.
happen? Maybe the value strategy may continue to underperform or may continue to outperform in the first half of 2023. But with the moment you expand the year as a whole, I think my sense is that growth should outperform the value. So I think it makes a lot of sense to redeploy whatever the money that you made in value strategy in 2022. By second half of 2022, you should basically shift from value to the growth to create
Hmm.
alpha on the portfolio.
Okay, so please stay on with us. I'll just go across to my colleague Akansha, who's standing by with a list of all those stocks that have been buzzing in trade today and those stocks that have been reacting on huge news flow. Akansha, over to you.
Okay, Sakshi. So Bharti Airtel is in the news. The telecom operator has acquired a strategic stake of around 8% in a startup under its Startup Accelerator program for an undisclosed amount. But the markets are not reacting well to this. The stock is down nearly 2%. It's down 1.85%. Next stock on our list is Dabur India, which is down 2.35%. The homegrown FMCG majors promoters, the Berman family, have sold shares amounting to about 1% of the whole company's valuation. And the stock market is not performing well. It's not taking this development well. And hence the share is down nearly 2.35%. Now let's talk about stocks that are doing well today. And we have Tirupati Forge, which is 4.35%. Mauritius-based Aegis investment fund has purchased 5 lakh shares of the company at rupees 22 per share. And they are engaged in manufacturing of closed die forged products like auto components, bearings, gears. And the market is taking this news as a positive cue. Next on our list is Future Enterprises. Future Enterprises is up 3.03%. Well, this is surprising since it's a debt-ridden player and it has defaulted on its interest payments of rupees 6 crores for its non-convertible debentures. The due date of the payment was December 19, but the stock is up 3.03%. And the last stock on our list is Sham Metallics and Energy. It's up 4.05%. The metal player said that it has forayed into stainless steel business and it has acquired a company called Mittal Corp uh, in an NCLT-led resolution process. And the
Right.
company, yeah, all right, back to you, Sakshi.
Thanks a lot, Akansha, for all that list. So I'll come back to you, Mr. Damania, to understand really a lot of sub-sectors have been moving off late. We've been seeing fertilizer stocks really rallying sharply in the last 1 month. There's been a rally of up to 120% odd in some of these stocks. So that's astounding. Apart from this, the sugar stocks are actually coming back into flavor. Some of the paper stocks are doing well as well. How are you looking at these several pockets, and do they actually merit investors' attention in the new year as well?
So I think let me just begin with the fertilizer stocks. And I think fertilizer, if you look at the fertilizer sector, I think it's not been a very consistent performance. So, it's always been a story of catching on the momentum and the moment you make some kind of a money, 25-30% kind of a gain, you tend to move out of that. If you look at last 5 years, I don't think any of the fertilizer company would have even double in terms of the capital appreciation. It's more of a momentum play, more of a news-based story. But it's again is a function of what's happening to the global warming and what's going to happen to the monsoon and so on and so forth. I don't know very what's going to happen. If at all you have to look at some of the fertilizer stocks, then maybe you could look at some of the company like PI Industries, which is more into synthesizes business. Basically, does it something very similar to what Divi's does to the pharmaceutical company. This company does it for the agrochemical, the fertilizer sector. I think that's what it makes sense. But otherwise, fertilizer is more of a commodity play, and the government of India coming out with that you can't basically promote your own brand. It has to be a white label. It does take away that the branding exercise, and that really makes little this one. And again, the government regulations is highly regulated, so you don't know what's going to happen tomorrow, and that could impact the prices. So yes, the momentum is very strong. Maybe it's a good time for investors to lock in some of the profits in the fertilizer stocks. As far as paper stocks are concerned, it looks like more like a structure, really more, we are extremely positive. In fact, 6 months back, we advised our investors to move into paper stocks, and they've done extremely well, whether it's a JK paper, whether it's Andhra paper, whether it's a West Coast paper. We recommended our investors to buy those companies because we are extremely positive on paper, and we continue to believe that the story is going to continue for the very simple reason that plastic is going to get replaced with the paper, and that's so. I think Indian paper companies will definitely command that kind of a premium. If you happen to listen to the commentary given by whether it's a JK paper, whether it's an Andhra paper, whether it's a West Coast paper, they continue to remain extremely bullish on the future demand outlook also. So we are constructively positive on the paper stocks.
All
Uh,
right.
yeah.
Yeah. Okay. On the macro front as well, there's some bigger decisions being taken by the capital markets regulator as well. So I'll take your viewpoint over there. We'd heard yesterday that SEBI has decided to phase out the mechanism of buying back of shares by companies through the open market route in a gradual fashion. Now, many believe this is following the recommendations made by the Keki Mystery report, which suggested that open market share buybacks are actually prone to be misused and should therefore be phased out. And the decision was a part of the several major decisions that were otherwise also taken by SEBI too. So first of all, your thoughts on this entire news, and how will it really benefit the small retail investors going forward?
So, Sakshi, if you look at this mechanism of buying back through the open market was definitely not beneficial to the small investors. Why? Because first thing, you don't know when company is going to buy back, because it's a long window is available and which date. And again, they would give the maximum price, but that maximum price is always much higher than the current market price. And we don't know how much quantity the bank company is going to buy on a daily basis. In the tender offer, against tender offer, you are very clear source or that company is going to buy back that much quantity of shares and the price, and that improves your chances of making money on that. So if you look at the data which is available, Sakshi, on the complete buyback, which is done through the open market mechanism, they hardly move the needle for the share prices. But when it comes to the tender offer, it did benefit small investors very. So I think it's a step in the right direction. It was need of an hour. I'm a little surprised why SEBI did it now. They should have done it 6 months back or maybe 9 months back. This kind of exercise was not making any sense from the shareholders' point of view. And it was anyway not helping to improve the sentiment on the share price also. So I think it's a move in the right direction.
Right. Also, as part of another decision, around 15 to 16 of the largest brokerage firms, including Zerodha, Grow, ICICI Securities, 5 Paisa, MOFSL, all will be designated as qualified stockbrokers now and will be subject to higher compliance requirements. And this is as part of attempts by SEBI to prevent concentration of broking power with little companies or too few companies right there. In fact, Chairperson of SEBI, Madhabi Puri Bhuj, really spoke about this in detail. Let's listen in to an excerpt right there.
In order to address the concentration risk which exists in our market today, there are, as you know, for instance, the top 10 or top 12 brokers will account for very, very large percentage of the market volumes. So in order to mitigate the concentration risk, what is proposed is that on the basis of some very transparent criteria, first of all, certain brokers will be identified or designated as qualified stockbrokers, and there will be an enhanced requirement on them in terms of risk management, of course, all types of risk, market risk, IT risk, cyber risk, etc. Much higher standards will be expected of them, and there will be a higher obligation on the MIIs and on SEBI in terms of monitoring them as well. So, for instance, in terms of our inspections, etc., frequency of inspection, regularity of review, etc., all of that, there will be a greater responsibility on the MIIs and on SEBI as well.
All right, Mr. Damania, your take on this and how will this news really impact the brokerage houses and the broking community and the investors going forward too?
So I think it's a move, and I'm not very sure how much is going to take away the market share from some of these leading brokers, whether it's Zerodha or Upstocks or other people. I think, yes, as a SEBI's duty to ensure that, there is no concentration of with the few brokers. But eventually, we have seen that's happening with the mutual fund industry, where few AMCs commands a much larger market size compared to what they were commanding even 10 years back, kind of stuff. And something similar happened with the discount brokerage happening. So yes, to have a check and balance in terms of IT, in terms of cyber risk, in terms of processes are being followed, that's a welcome step. But is it going to help in terms of reducing the concentration from this broker? My answer seems to be no. In fact, some of the smaller brokers are anyway giving away that space to the larger brokers. So my sense is that it's going to remain the same. It's going to remain. But this kind of an oversight is a welcome move. That will definitely help to improve any kind of an unwanted mishap that could have happened because of cyber, or because of IT software is related issue. But it's not going to reduce the concentration risk.
Okay, noted that. Well, thank you so much, Mr. Damania, for being with us on the show and sharing your insights on the markets overall in several segments that we've spoken about. Let's look at the closing action of the markets. The markets have shut shop for the second consecutive day in the red. Sharp declines on the benchmark, 635 points gone there for the Sensex. It's just managed to stay up above that 61,067 kind of a mark, but definitely a cut of over 1% is what you've seen. Similar cuts for the Nifty as well. 18,200 has been breached on the downside for the Nifty 50. And 186 point of a loss is what we've seen for that one too. In terms of the various other sectors, the mid and the small caps definitely seeing some sharp cuts, especially the small caps that have underperformed the benchmarks and declined by over 2.4% odd. In terms of the various sectors, it is the media stocks that have declined the most. Apart from this, that's the PSU banks that have led the losses in today's trade. 2.9% gone for that one, about 2% of a loss clearly for the metals pack, 2.3% of a cut right there, almost a 2% cut for the realty space, for the private banks as well, 1.5% gone for the auto space. The FMCG basket slips about 0.8%. The only two bright spots remaining in the session today, clearly the pharma stocks led from the front in an overall muted market, 2.5% uptick for this one. The IT space also seeing gains of up to 0.5% in today's trading action as well. The top gainer clearly Davis Laboratories, 3.6% up in trade today despite the overall weakness, followed by the other names from the pharma and healthcare basket. On the losing side, it's the Britannia stock and Adani Enterprises, ITC, all of these stocks that have actually led from the bottom, in fact, as far as the losers are concerned. We'll wind up this show now, but do stay tuned on to Business Today TV for a whole lot more coverage on from the world of business and stock markets too. Many thanks for tuning in onto this edition.